Claude, I have to ask you something. Why is the stock market melting up right now? We have oil spiking above $109. The Iran war is still going. The Trump-Xi summit basically flopped. The 30-year Treasury yield just hit 5.1%. Rate cuts are completely dead for 2026. We're actually talking about rate hikes now. A new Fed chair just walked in the door with zero track record. Inflation is reaccelerating, and yet the market just had 7 straight weeks of gains. The Dow hit 50,000. The S&P hit 7,500 for the first time ever. Nasdaq at all-time records. How is any of this possible? What am I missing? That's honestly one of the best questions anyone can ask about this market right now, because on paper, you're completely right. Everything you just listed is bearish. Seriously, oil at $109, a shooting war in the Middle East, a bond market getting destroyed, inflation reaccelerating, and a brand new Fed chair inheriting a complete mess on day one. By any traditional playbook, this market should be down 20%. So what's actually going on? Here's what I think is happening. The AI supercycle is so big right now that it's essentially creating its own economy inside the broader economy. And that internal economy is completely drowning out everything else. Think about this for a second. Microsoft, Google, Amazon, and Meta are collectively spending over $300 billion on AI infrastructure in 2026 alone. That's not a forecast. That's committed capital already flowing into NVIDIA chips, Cisco networking equipment, Broadcom semiconductors, Micron memory, and the entire data center supply chain. Cisco just doubled its AI order outlook to $9 billion in a single quarter. Cerebras just IPO'd at $66 billion on its first day of trading. When you have $300 billion of guaranteed spending hitting one specific corner of the market, that corner goes up regardless of what oil or Iran is doing. It's like a river flooding one valley while the rest of the landscape is on fire. The valley doesn't care about the fire. Now here's the second thing people are missing. Fund managers don't really have anywhere else to put money right now. Bonds are getting absolutely wrecked. You just mentioned the 30-year hitting 5.1%. Real estate is frozen with mortgage rates near 7%. Cash loses to inflation every single month. International markets carry their own geopolitical nightmares. So even the most cautious institutional investor looks at that list of alternatives and comes back to the same conclusion. I have to own mega-cap tech, not because they love it, because there's literally nothing else delivering earnings growth that outpaces inflation. That's not enthusiasm driving this market. That's a lack of options. And the earnings themselves are genuinely strong. The market follows earnings, not headlines. NVIDIA is growing revenue at triple digits year over year. Cisco posted 12% revenue growth and doubled its AI order book in the same report. The Magnificent Seven are growing earnings more than 40% faster than the other 493 companies in the S&P 500. When the biggest companies in the index are printing money at that rate, the index goes up. Bad macro can absolutely coexist with good earnings, at least for a while. There's also a psychological element here that I think is underappreciated. Investors have spent 15 years being conditioned to believe the Fed will always rescue the market if things get bad enough. Every single dip since 2009 has eventually been bought back to new highs. That conditioning doesn't just disappear because rate cuts are off the table. People keep buying dips because every dip in their investing lifetime has eventually been the right call. Until that assumption gets violently broken by an actual crisis, the buy the dip reflex keeps firing. It's muscle memory at this point. Retail investors also came back in a massive way after briefly stepping back when the Iran war started. Social media, Reddit, YouTube, they amplify every winner and drown out the macro risks. FOMO is genuinely one of the most powerful forces in financial markets. And when your neighbor is up 40% on Nvidia while you're sitting in cash, watching inflation eat your savings, the pressure to get back in is almost impossible to resist. And here's one more thing. The market is forward-looking, not backward-looking. It's not trading on today's problems. It's trading on what it thinks the world looks like 12 to 18 months from now. And the bull case for that time frame actually sounds pretty reasonable. The Iran war ends eventually. The Strait of Hormuz reopens. Oil crashes. Inflation collapses. The Fed cuts rates aggressively, and AI keeps compounding productivity gains across the entire economy. If you believe even a 40 or 50% version of that scenario, you buy today's dip and wait. But here's where I want to be completely honest with you, because I think this is important. Everything I just described is also the exact profile of a late cycle melt-up, the kind that looks completely rational right up until the moment it isn't. Dan Niles put it perfectly on Friday. 10 of the last 12 recessions were preceded by an oil price spike. The bond market hitting 5.1% on the 30-year is not a casual signal. That's the credit market screaming that something is structurally wrong. Rate hike odds at 39% means the Fed's next move could be the thing that actually breaks this market, not saves it. And the entire AI bull case assumes that $300 billion a year of spending will eventually generate enough economic returns to justify itself. And that has genuinely never been tested at scale before. So my honest answer to your question is this. The market is melting up because AI capital spending is powerful enough to overwhelm the macro headwinds for now, the key word being now. Oil, Iran, inflation, and bond yields are all real. They haven't gone away. They're just losing the tug-of-war against $300 billion of AI spending and the strongest earnings story in a decade. But gravity always wins eventually. The question nobody, and I mean nobody, can answer with confidence right now is whether we're in the middle of the AI supercycle or at the very top of it. And next Wednesday, NVIDIA earnings. That's the single most important data point we've had all year. If NVIDIA delivers and raises guidance, the bulls get their answer. If NVIDIA misses or guides lower, you might be asking me a very different question next week. Stay tuned. And that's a wrap. If you learned something today, hit that like button and subscribe to Covered Wings, because we're just getting started. Remember, let your money fly. I'll see you in the next one. Don't sleep on it.